I genuinely believe most people fail challenges for reasons that has nothing to do with trading skill. Welcome to episode 14 of the JOINPROP podcast. I am the head of content here, and I'm joined today to really dig into a guide about prop trading challenges that is honestly kind of terrifying.
Yeah. Hi. I'm sitting here staring at these statistics you sent over, and I literally need a second. 90%.
Yeah.
90% of people fail. That is a slaughter. That's not an evaluation. That's a meat grinder.
It's brutal. It really is.
Because when you say prop firm, proprietary trading, my brain immediately goes to Wall Street, guys in Patagonia vests with Bloomberg terminals. But this guide is talking about everyday retail traders. You and me.
Right. Retail traders who want access to firm capital.
They pay an evaluation fee, right? And they take a test. And if the pass rates are below 10%, I have to ask, is that literally their business model? Just maliciously failing everyone to collect a $500 entry fee.
Okay, so right, that is the immediate reaction. Literally everyone assumes it's a scam. But look, it's not a scam.
I'm not saying illegal. I'm saying it feels like one. It feels structurally rigged.
It's unforgiving, for sure, but it's not a trap in the way you're thinking, because the firms are putting up real capital for the people who actually survive. The guide points out they're offering 25 grand on the low end, up to $400,000.
Which is insane money to hand a stranger on the internet.
Exactly. And they let you keep 50, 80, sometimes 90% of the profits you make with their money. If you're a firm taking on that kind of catastrophic risk, your vetting process has to be unspeakably brutal. You have to filter out the gamblers.
Okay, but wait. If it's not a lack of trading skill, if they aren't failing because they don't know what a chart is, then what is it? Because a sub 10% pass rate screams that you built a maze designed to crush the rat.
The walls are definitely closing in. But it's a test of discipline. It's an extreme pressure cooker. But wait, let me back up. Let's actually look at the structure of the gauntlet itself. Because if you're listening to this and you don't understand the arena, the rules we're going to talk about will make zero sense.
Yeah, break that down, because the guide mentions 3 distinct phases, and honestly, just reading the requirements for phase 1 gave me secondhand anxiety.
Right. So phase 1, the initial evaluation, the firm says, show us what you can do. You have to hit a profit target, usually 8 to 10% of the starting balance.
So on a 100 grand account, I need to make 10 grand.
Exactly. But you have to do it while respecting these incredibly tight drawdown limits.
Okay, define drawdown limits exactly. I want to make sure the math is crystal clear for anyone not staring at a terminal all day.
Sure. Drawdown is basically how much your account drops from its peak or its starting balance. And these firms usually have 2 hard limits and an overall max loss and a daily max loss. The overall loss is usually around 8 to 10%.
Okay, so if my 100 grand account drops to 90,000, I'm disqualified.
Game over. You're out.
Oh.
But the daily loss limit is the real killer. It's usually 4 or 5%.
So I have an account of 100 grand. I need to make 10 grand. But if I lose 5 grand on a random Tuesday, I'm out.
Instantly. The dashboard locks you out. You get an email saying, better luck next time.
Look, that feels structurally unforgiving. Actually, wait, what's the time frame for this? How long do I have to make the 10%?
Historically, a lot of firms had a strict 30-day time limit. 30 calendar days. Which is only about 22 actual trading days.
Are you kidding me? Doing 10% in a month. Hedge funds, literal teams of MIT quants aim for maybe 15-20% a year, and you're supposed to do half of an annual return in 4 weeks without ever having a bad day where you dip 5%.
Which is exactly why people blow up. You just nailed the exact paradox. Traders look at the clock ticking down, they look at the 10% target, and they just start swinging for home runs.
Right, they panic.
They take massive position sizes to get there fast. They force trades. But then, and this is where it gets truly sadistic.
Yes.
Let's say you survive. Let's say you hit the 10%, you dodge the daily loss limit, you pass phase 1.
Okay.
Then comes phase 2.
The guide calls this the consistency bar.
Yes. So phase 2 usually drops the profit target. Instead of 10%, maybe you only have to make 5% this time.
Right.
But the loss limits the 5% daily, the 10% overall, those stay exactly the same.
Wait, why? I don't get that. If I already proved I can make 10% under pressure, why is the second hoop lower?
Because they're trying to prove phase 1 wasn't a fluke.
Oh.
It's actually a psychological trap. Think about it. In phase 1, an aggressive trader might just take a massive risk. They YOLO a high-leverage trade on gold, they catch a lucky trend, and boom, they hit 10% in 3 days.
They treated it like a slot machine and hit the jackpot.
Exactly. So in phase 2, the firm is basically saying, okay, do it again, but slower. prove you have a repeatable system. You don't need massive risks to hit 5%. But gamblers, they don't know how to trade without swinging big. So they did the exact same giant swings in phase 2. They hit one normal patch of bad luck, and they trigger the daily drawdown.
So phase 2 is essentially a lie detector test. It filters out the lucky from the skilled.
That is the perfect way to phrase it. And then finally, phase 3 is when you actually get funded. You get a live account or a simulated one where they copy your trades and you start earning the profit split. But by phase 3, you've survived a massive filter, specifically designed to weed out impatience.
Okay, but look, I am going to push back here. Even if it's a lie detector, the parameters of the test dictate the behavior. You are dangling 400 grand in front of someone who probably really needs the money. You charge them a fee. You set a 10% target alongside a max loss limit that is almost identical to the target. You are effectively forcing them to take huge risks to hit the target, but punishing them the exact second that risk turns against them. That feels like a trap.
I hear you. It is unforgiving. But that brings us to the entire thesis of the first section of this guide. The paradigm shift. You cannot, under any circumstances, trade a prop challenge the way you trade your own personal account.
Well, let's dig into that, because tip 1 is analyze the firm's specific rules, which is kind of obvious.
Yeah.
But tip 2 is where my brain stalled out. It says, scale down position size radically. The guide advises dropping your risk exposure from a standard 2% per trade down to 0.5%. Or 1% max.
Yes, that's the golden rule.
But explain the math on that. If I, the listener, need to hit a huge 10% profit target, why on earth would I cut my betting size by 75%? If I risk less, my winners are smaller. That makes the 10% mathematically harder to hit.
No, look, this is exactly the trap that kills 90% of people.
Okay,
let's look at personal trading first.
Yeah.
Imagine you have your own retail account, say 10 grand. Your strategy says you risk 2% per trade. So if you lose 200 bucks.
Standard risk management.
Right. Now think about variance. Even the greatest traders on earth will occasionally lose 5 trades in a row. It's a mathematical certainty. So you lose 5 trades at 2% risk. You're down 10%. Your 10 grand account is now 9 grand.
Right. It's annoying, but I'll live. I still have 9 grand to trade with next week.
Exactly. You live to fight another day. But what happens if you do that in a prop challenge?
Oh, the 10% max drawdown.
Yes, that 10% drawdown is a hard, unbreakable electric fence. You lose 5 trades at 2% risk in a challenge, your account is instantly breached. They take it away. You don't get to wait for better conditions next week. You are dead.
Okay, so the game isn't actually make 10%. The psychological game is never, ever hit the invisible electric fence at negative 10%.
Yes. You have to flip your entire worldview. When you trade your own money, you play offense. You're trying to grow. When you trade a prop challenge, you are playing defense. Your only goal is daily survival. It's like taking your driver's test.
Okay, I'm with you.
Think about how you drive your own car on a random Tuesday. You might roll through a stop sign if it's empty. You might speed up on a yellow light. You might drive with one hand while drinking coffee.
I feel mildly attacked, but yes.
Because in your own car, you absorb your own risk. The consequences of a rolling stop are usually 0. But imagine you're taking the state driving test. The instructor's in the passenger seat with a clipboard. Are you doing a rolling stop?
Absolutely not. My hands are glued to 10 and 2. I am coming to a complete shuddering halt. I am counting to 3 Mississippi before hitting the gas.
Exactly. You are operating under highly scrutinized, artificially hazardous conditions. The challenge is the driving test. The problem is, retail traders step into the challenge and they drive like they're late for work in their own car. They bring all their personal habits, risking 2%, holding through massive news events into the challenge.
And the firm just quietly checks the box, fails them, and keeps the fee.
Yes. That's why the guide is screaming at you to develop a challenge-specific, hyper-conservative plan. You drop your risk to 0.5%, because now, to hit that 10% drawdown, you would have to lose 20 trades in a row.
Okay, the math makes total sense now. Losing 20 times in a row means either your strategy is entirely broken or you are having a total psychological meltdown.
Exactly. It gives you the padding to survive normal variance.
It makes sense, but honestly, it's really dark.
Yeah.
Because the marketing for these firms on YouTube, Instagram, it's all Lamborghinis and Dubai skyscrapers. But the reality of passing is literally hands at 10 and 2, hyper-conservative defense. It's the most boring way to trade.
It is incredibly boring. And people hate it. But just knowing you need a conservative plan isn't enough. which leads into the simulation phase. And this is where egos get really bruised.
Right, the guide talks heavily about preparation, and I'll be honest, this part actually annoyed me.
Really? Why?
The guide says, and I'm quoting, practice with demo accounts for at least 30 days before a real attempt.
Yeah, that's the bare minimum, honestly.
Okay, but put yourself in the shoes of the listener. Let's say I'm already a profitable trader. I've traded my personal account for a year. I have a strategy. Why do I need to spend an entire month of my life sitting in a simulator, fake trading Monopoly money? Isn't that just wasting a month where I could be passing the real challenge and making actual money? You're assuming people just have 30 days to burn. That feels incredibly elitist.
Okay, I hear the impatience there, I really do. But honestly,
Yeah.
if you don't have 30 days to practice a specific operational framework, you definitely shouldn't be trying to trade for a living. The market isn't going anywhere.
People have bills to pay, though. They see the 100K account as a way out of a bad job. They don't want to wait a month.
But that desperation, that feeling of, I need to make this money right now, is exactly what the firms are filtering out. Desperate traders take terrible setups. Look, the 30 days in the demo, it's not about learning how to trade. You already know your strategy. The simulator is about building literal muscle memory for the artificial rules of the challenge.
Building muscle memory for avoiding the electric fence.
Yes, because if you don't meticulously track your metrics in that specific environment, you will blow up. The guide demands you track win rate, risk-reward ratio, drawdown, and profit factor.
Let's define those, because profit factor sounds like middle management jargon. Explain what that actually means.
Sure, profit factor is, wait, let me make sure I explain this right. It's just your gross profits divided by your gross losses over a specific time period.
So if I make $1,000 on my winning trades and lose 500 on my losing trades, my profit factor is 2.
Exactly. You made twice as much as you lost. A profit factor above 1 means you're profitable. But here's why you need the demo to track it. Let's say your personal strategy has a win rate of 40%, meaning out of 10 trades, you lose 6.
Which sounds terrible to an outsider. You're wrong more than half the time.
It sounds terrible, but in trading, it can make you rich. Because of the risk-reward ratio, let's say your risk-reward is 1 to 3. Every time you're wrong, you lose $100. But when you're right, those 4 times out of 10, you make $300. Over 100 trades, you are highly profitable.
Okay, I follow the math. Lose small, win big. So why would that fail a prop challenge?
Because of how a 40% win rate feels against a strict drawdown limit. If you only win 4 out of 10 trades, you are statistically guaranteed to hit a losing streak of 5 or 6 trades in a row at some point. That's just variance. If you haven't dropped your risk to 0.5%, that totally normal losing streak will trigger your max drawdown. Your account will be breached by a perfectly profitable strategy.
Oh, wow. Okay, so the simulator isn't about proving you can make money. It's the simulator telling you, hey, your returns are too volatile for these specific rules. Tweak it.
Exactly. You make your calibration mistakes with fake money. If you hit a 6% drawdown into the simulator, you just hit reset. If you do that on a live evaluation, you just lit $500 on fire. And there's another thing the demo teaches you: optimizing your trading hours.
Like waking up early?
Kind of. The markets are open 24 hours a day, 5 days a week. But they act differently depending on which global banks are awake. You might find out during your demo that your specific strategy only works during the first 2 hours of the New York session.
So if I try to force a trade at 3 p.m. just because I'm bored, I'm basically trading a completely different market.
And you will bleed money. But you only discover that data by tracking it in a simulator.
Okay, I concede the point. The simulator is a calibration chamber. But let's say I do that. I put my ego aside, I spend the month in the demo, I pay the fee, and I am in phase 1. This brings us to the daily reality of the challenge. And honestly, this section completely broke my brain. It violates every instinct in the human body.
You're talking about the recovery strategy.
Yes. The guide says to prioritize consistency, which is fine, but then it talks about how to handle a losing streak. It says you need a recovery strategy that includes, quote, reducing position sizing further when you are losing.
Yeah, that is the holy grail of survival right there.
Hold on. Are you biologically human? Because cutting your bet size when you're losing, human nature is literally the exact opposite of that.
I know.
Think about it. If I go to a casino and lose $50 on a blackjack hand, my immediate visceral instinct is to bet $100 on the next hand so I can break even.
Right, the martingale strategy. Double down.
Yes. It's an innate desire to erase the pain of the loss. And you're telling me that if I take a loss, I have to take my already tiny 0.5% risk and shrink it down to 0.25%. I have to win 2 or 3 trades just to recover from one loss.
Yes.
That is infuriating. That would make me so angry. It feels like willingly stepping into quicksand.
And that anger,
Yeah.
that visceral fury you just described,
Yeah.
that is exactly why 90% of people fail. Listen to your words. You're talking about anger, about getting it back, about ego. The market is a neutral entity. It does not know who you are. It does not owe you a winning trade just because you are upset.
I know the market doesn't care, but my adrenaline is spiking. My ego cares.
And prop firms are not in the business of funding your ego. The guide literally states, firms seek reliable performers. Think about your casino analogy. Firms aren't looking to fund the gambler who doubles down and hits a lucky roulette spin. They want to fund the casino itself.
Steady, boring, mathematical edges.
Yes. The house edge in a casino is tiny, like 1 or 2% on blackjack. They don't care if a player wins a few hands, because they manage their risk strictly. They never bet the whole casino on one hand, and over millions of hands they print money. You have to be the casino.
Okay, but mechanically, why reduce the size? Why not just keep the risk exactly the same at 0.5 until you win?
Because when you're in a drawdown, 2 things are happening. First, statistically, your strategy might be out of sync with current market conditions. The market might have shifted from trending to ranging. Second, your psychology is compromised. Your cortisol is elevated. Your vision narrows. You are prone to making mistakes.
So you're trading worse because you're losing.
Exactly. The absolute worst thing you can do when you're spinning out on an icy road is to slam on the gas pedal. You will crash into the wall. Reducing your risk to 0.25% is letting off the gas. It slows down the bleeding and gives your brain time to calm down.
Okay, the ice analogy works perfectly. You don't floor it, but you need incredible discipline to do that in the moment.
Which is why the guide mentions a daily risk budget.
Is that different from the firm's daily loss limit?
Entirely different. The firm's limit might be 5%. If you hit that, you lose the account. So a smart trader creates their own internal budget that is much smaller, say 2%. You decide before the day begins, if I lose 2% today, I am done. I will physically close the laptop and walk away.
Have you ever actually done that, though? Just walked away while your screen is red? It sounds so easy in theory, but in practice.
Oh, I failed miserably at it. It is excruciating. You're sitting there, your chest is tight, and your brain is screaming, just one more trade. I can fix this. I can make it green before lunch.
Right, because ending the day in the red feels like a personal failure. You carry it all day. You're eating dinner, thinking about the money you lost.
But think about the alternative. If you take that revenge trade, and it's at a revenge trade, and it loses, now you're down 3, maybe 3.5%. Now you are dangerously close to the firm's actual limit. You are risking your entire evaluation fee simply because you couldn't tolerate a little bit of emotional discomfort.
This transitions perfectly into the final section.
Yeah.
Because listening to you describe that chest-tightening feeling, we're not actually talking about finance anymore. We're talking about behavioral psychology. We're practically talking about therapy.
Pretty much the final boss of a prop challenge is your own mind.
The guide says to master psychology through strategies like journaling and predetermined break protocols. And it lists common failure points.
Let's walk through those.
It lists overtrading from pressure, poor strategy adaptation, psychological derailment, insufficient preparation, and excessive risk-taking.
Psychological derailment. That is such a clinical way of describing a complete mental breakdown under the stress of a ticking clock.
Let's explore that ticking clock, because overtrading from pressure, that usually happens when a trader is close to the phase 1 time limit, right? They have 3 days left to hit 10%, and they're at 8%.
You are so close you can taste it.
Right. But having a time limit forces you to take bad trades. You are cornering a rat. If I need 2% in 3 days to avoid failing, I am going to take setups I would never normally touch.
The firm would say it tests your discipline under pressure.
No, it tests your desperation. If the market is chopping sideways, a disciplined trader sits on their hands. Protecting capital is the job. But if the firm says you fail in 72 hours, they are actively forcing the trader to abandon discipline and gamble. That is exactly why I said it's a structural trap.
I completely see your point. It creates an artificial conflict. But the firm's counterargument is, if you cannot manage your emotions and keep position sizing conservative when an arbitrary deadline is approaching, how are you going to manage millions of dollars of live capital when the actual market is crashing?
I mean, fair. It's a stress test.
And honestly, the industry is shifting. A lot of top-tier firms have eliminated the time limits entirely now because they realized it was forcing bad behavior. But here's the crazy part. Even without the time limit, people still overtrade from pressure.
Really? Why would you rush if you have unlimited time?
Because they're impatient. They want the funded account today. They want to post the certificate on Instagram. Their own internal psychological clock kills them.
They defeat themselves. Which brings us to another failure point. Poor strategy adaptation. Mechanically, how does that happen?
Let's say you have a strategy for a trending market. For 3 weeks, the eurodollar is just stair-stepping upward. You're buying dips, making money, feeling like a genius. But then a central bank report comes out and the market stops trending. It just enters a volatile sideways range.
Just chops back and forth.
Right. A logical machine would recognize the market regime has changed and stop trend trading.
Yeah.
But the human brain, it has recency bias. It says, this worked yesterday, it has to work today. So the trader keeps buying the dip and the price just breaks their stop loss. Again and again, the brain refuses to accept the environment changed until the account is blown.
That's fascinating. Admitting the strategy doesn't work means admitting you don't control the market. It's an ego defense.
Exactly. And the only way to combat that is the journaling protocol the guide suggests. Now, when you read journaling in a financial guide, what did you picture? Be honest.
Honestly, I pictured a leather-bound diary with a little lock.
Dear diary, today the eurodollar was mean to me.
It sounds incredibly woo-woo for a quantitative field.
Right. Everyone thinks it's a feelings check. But in professional trading, a journal is a forensic tool. More importantly, it is a literal physiological circuit breaker for your brain.
How so?
Okay, neuroscience for a second. When you lose a trade unexpectedly, your amygdala, the emotional center of your brain, lights up. Adrenaline spikes. You enter fight or flight. Your brain wants to fight back, which means revenge trading.
You want to click the mouse and buy immediately to get it back.
Yes. But if you have an ironclad rule that says, I must log every single trade in my journal before taking another one, you force a pause. You want to re-enter, but your rule forces you to open an Excel spreadsheet. You have to type the exact entry price, calculate the exit price, write down the setup criteria, and note your emotional state on a scale of 1 to 10.
Oh, wow. That is brilliant.
Why?
Because you are tricking your brain out of fight or flight by giving it a boring administrative task.
Exactly. Filling out a spreadsheet requires logic and syntax. It forces blood flow out of the amygdala and into the prefrontal cortex, the logical part of your brain. By the time you finish typing the forensic details, the adrenaline spike is dissipated. The urge to revenge trade is gone. You look at the chart with your prefrontal cortex and realize, wow, entering again here would be incredibly stupid.
Okay, I take back the Dear Diary comment. That is a highly functional protocol. But stepping back, it points out a massive, hilarious irony about this entire industry.
What's the irony?
You have people studying macroeconomics, drawing complex Fibonacci retracements, building algorithmic models, trying to pass a highly technical exam. But the biggest obstacle, the reason 90% fail, is just a lack of emotional maturity. You don't fail because your math was wrong. You fail because you threw a tantrum when the line went down instead of up. You aren't fighting the market. You're fighting your own adrenaline.
That might be the truest sentence ever spoken on this topic. The market is just a mirror reflecting your own lack of patience back at you.
It's wild. The market is basically an expensive monastery.
It really is. And, as we wrap this up, if you're listening right now, even if you never plan to take a prop challenge, applying this challenge-specific plan to your own finances is basically a masterclass in wealth preservation.
Seriously. Imagine using a daily risk budget for Amazon purchases. Okay, I hit my $50 drawdown for impulse buys today. I must physically close the app.
Right. Or managing emotional reactions in your 401k. If the stock market dips 5%, the instinct is to panic sell. But if you have a recovery strategy and understand statistical variance, you just let off the gas and wait for the regime to shift back.
Yeah, the rules of passing a prop challenge are basically just the rules of not ruining your own life with impulsive decisions.
Exactly. So to distill all this, prop firms are offering life-changing capital. If you pass $400,000 can alter your life trajectory. But that sub 10% pass rate, it's a toll booth. And the only people getting through are the ones who are excessively disciplined, mechanically consistent, and entirely emotionally regulated.
Which is almost nobody.
Which is almost nobody. It's a rare trait.
It leaves you with a lingering thought, though. Something to chew on.
What's that?
Well, if 90% of people fail almost entirely due to a lack of emotional control, revenge trading, and poor risk management, What does that say about our natural human wiring? Are we biologically programmed to be terrible at trading? Is the nature of financial markets so antithetical to survival instincts that we have to radically, painfully override our own brains just to break even?
That is a massive question. Are we biologically unfit for the market? Probably. And that is probably a perfect place to leave it for today. There's so much more we could unpack, but we'll save that for the next deep dive. For now, if you're staring at a red screen, maybe just close the charts, take a breath, and go for a walk. We'll see you next time.